What's going on, guys? Hope you're having an absolutely fantastic day. So Warren Buffett's Berkshire Hathaway just released earnings yesterday. And of course, with those earnings come the famous Warren Buffett letter to shareholders, right? There are so many gems in this letter, which is why I decided I have to make a video, right? So fun fact, I'm actually using Internet Explorer to record this video because this is the only web browser that will let me highlight the PDF without doing some ridiculous stuff, right? So yeah, let's get into the video, right? So first of all, we can see that Warren Buffett's performance is 3.7 million 874,064%, right? So wow, that's a really hard number to read, especially because they put the commas like that. But if you take a look at this number, it's absolutely mind-boggling, right? And I think probably no one will surpass Buffett's record, right? Just the length of time that he has been compounding from 1965 to 2022, and at the rate that is compounding, right, which is basically 20%, right? So I think there will be people that will have even higher performance, which is like maybe 65% a year. Like I think Jim Simons or something like that did like a 50% annualized for, I don't know, 10 years or something, right? But of course, that is catching up to Warren Buffett if he lives as long as Warren Buffett, right? But basically, the reason why I say probably nobody will catch up to this record is because of the length of time he has been doing it, and also the age that he's lived to, and also the rate that he's been performing at, right? And to put into some context, what this 3.7 million number represents is basically a 37,874x, right? So $1 you put in with Warren Buffett in 1965, basically you will have $37,874, right? So that's just an absolutely insane number, right? So I've highlighted most of the important points. Charlie Munger, my longtime partner, and I have the job of managing savings of a great number of individuals. We are grateful for their enduring trust, a relationship that often spans much of their adult lifetime, right? So of course, if you invested with Warren Buffett, you'll be doing really well for yourself, right? And the best part is you wouldn't even have to have done anything for the past 40 years. You would have been able to spend all your time fishing or something like that, right? And you'll still be really rich, right? And another point is, who wouldn't enjoy working for shareholders like ours? Which means he's still very happy to show up to work. And I think this is one of the core lessons that we can learn from his letters as well, right? That he really enjoys what he's doing. And that's the reason why he probably strives at what he's doing, right? Other than the fact that he's a genius. So Charlie and I allocate your savings at Berkshire between two related forms of ownership. So first, we invest in businesses that we control, buying 100% of each. And second is obviously the equity investments. So disappointment are inevitable. We are understanding about business mistakes, but our tolerance for personal misconduct is zero, right? So this is something Warren Buffett has repeatedly stated, right? So you can lose us money, but don't lose our reputation, right? Holding these investments, we have no say in management. This is for the publicly traded stocks, right? So you can see that this page is basically fully highlighted, right? And anyone that say, oh, you just highlighted the whole page, I think I would be quite happy that if my audience retention is only up to this point of the video, because I think this is a letter that you should read in its entirety, right? Not just the highlights, right? Even though I basically highlight mostly everything, right? So yeah, our goal in both forms of ownership is to make meaningful investments in businesses with both long-lasting, favorable economic characteristics and trustworthy managers, right? So take note of this, right? Meaningful investments, right? So it doesn't matter if you buy like a really great business with 1% of your portfolio, right? It's not a meaningful investment, right? And the two favorable characteristics that he looked for are economic characteristics and trustworthy managers, right? Please note that particularly that we own publicly traded stocks based on our expectations about their long-term business performance, not because we view them as a vehicle for adroit purchases and sales, right? That means they are buying publicly traded equities, not for the liquidity, but for the business performance, right? That point is crucial. Charlie and I are not stock pickers, we are business pickers. So over the years, I have made many mistakes. Consequently, our extensive collection of businesses currently consists of a few enterprises that have been truly extraordinary economics, right? Sorry, that have truly extraordinary economics, many that enjoy very good economic characteristics, and a large group that are marginal, right? So basically saying that they have a large group of businesses which are not as good as maybe their core businesses that they have the huge holdings in, right? So along the way, other businesses in which I have invested have died, so their products unwanted by the public. Capitalism has two sides: the system that creates an ever-growing pile of losers while concurrently delivering a gusher of improved goods and services. This is what is called creative destruction. So one advantage of our publicly traded segment is that episodically it becomes easy to buy pieces of wonderful businesses at wonderful prices. It is crucial to understand that stocks often trade at foolish prices, both high and low. Efficient markets exist only in textbooks. In truth, marketable stocks and bonds are baffling, and their behavior only understandable in hindsight. Right? So I think this is really, really important to highlight, right? It becomes easy to buy pieces of wonderful businesses at wonderful prices, right? That's what you're always looking to do, right? And stocks can be irrational both on the upside and the downside, right? So control businesses are different breed. They sometimes command ridiculously higher prices than justified, but are almost never available at bargain valuations. So obviously, when you have a controlled business, smart buyer and smart seller, which obviously Warren Buffett is a smart buyer, and there'll be someone holding their business, which is a smart seller, and you never get a bargain basement price for that, right? So at this point, a report card is from me is appropriate. In 58 years of Berkshire management, most of my capital allocation decisions have been no better than so-so. This is a bit of humble brag by Buffett, right? I'm pretty sure this is humble brag, right? So in some cases, also bad moves by me have been rescued by very large doses of luck, right? So obviously, the harder you work, the luckier you get. And sometimes you do really get lucky with some investments, right? So remember our escapes from near disasters at US Air and Solomon? I certainly do. So of course, the US Air one, I'm not so clear with it, but the Solomon one, I'm quite clear with it, right? Our satisfactory results have been the product of about a dozen truly good decisions. That would be one about every 5 years, right? So that's quite crazy to think of, right? One decision every 5 years can really build a fortune for you, right? And yes, if you made one good decision in the 1960s or even the 1970s or even the 1980s to invest in Berkshire, you would have been set for life, right? If you, again, had put a meaningful investment, right? And that's the importance of the first part of the letter, right? So in August 1994, yes, 1994, Berkshire completed its 7-year purchase of 400 million shares of Coca-Cola we now own. The total cost was 1.3 billion, then a very meaningful sum at Berkshire. So the cash dividend we received from Coke in 1994 was 75 million, which is quite staggering, right? Because that is basically a 5% dividend with the amount that Coke has grown. 5% dividend with that. Yeah, you could have said that in 1994, Coke was obviously a very, very attractive buyer. So by 2022, the dividend had increased to 704 million. So every 2 years, basically, they get back their cost price. Growth occurred every year, just as certain as per day. All Charlie and I were required to do was cash Coke's quarterly dividend check, and we expect those checks to likely grow, right? So of course, something to note is that it was not actually that simple, right? Because obviously Coke went through some tough times. The financial crisis, you could have panicked out and sold. And actually, investing, I think this is a very core tenet of investing, right? Every day you have to wake up and make a good decision, which is not to sell, right? If the business is good and all that, right? And I think this is putting it as an understatement, and basically Warren Buffett basically being humble, right? Because every day when you wake up, you have to decide not to sell, right? And that's also a decision you have to make. So American Express is much of the same story. So Berkshire purchases of Amex were essentially completed in 1995. Coincidentally, also cost 1.3 billion, and annual dividends from this investment have grown from 41 million to 302 million. Those checks too seem highly likely to increase. These dividend gains, though pleasing, are far from spectacular, right? But they bring with them the important gains to stock price. At year end, our Coke investment was valued at roughly 25 billion, so that's roughly 20x, while Amex recorded 22 billion, right? So each holding now accounts for roughly 5% of Berkshire's net worth, right? Akin to its weighting long ago. So when they started these investments, I think it was a bigger weightage, right? So again, weighting is very important, right? Because if you don't invest enough initially, your results will not be significant as well, right? Even if you invest 1% into a 100 bagger, right, you will only end up doubling your portfolio, right? But if you invest, let's say 10% in a 100 bagger, then your portfolio will 10x just from that one position, right? And of course, if you invested in something like Berkshire, even if you invested 1%, you'll be quite happy, right? So assume for a moment I had made a similar size investment, but of course, that's not what I'm talking about, right? I'm focusing on mainly that when you have a good opportunity, you have to swing hard, right? This is just assume for a moment, right? So basically, he didn't do this, right? An example would be a high grade 30-year bond. That disappointing investment would now represent an insignificant 0.3% of Berkshire's net worth and would be delivering to us an unchanged 80 million or so of annual income. So this is again, he really does emphasize on moving the needle, right? Basically, this is what he means, right? So 0.3% of Berkshire's net worth, of course, is still a lot of money overall, but you have to look at what moves the needle. So the lesson for investors: the weeds wither away in significance as the flowers bloom. Over time, it just takes a few winners to work wonders. And yes, it helps to start early and live well into your 90s, right? So hopefully he lives into his hundreds, right? So for Berkshire's earnings is 30.8 billion, and of course this excludes some of the hidden earnings, right? Which is basically things like Apple, Coca-Cola, Amex, all these investments, they only account for the dividends paid, right? Not the earnings stake, right? So I think the real earnings would be somewhere higher, right? Maybe 10-20% higher. I don't know the exact number at this moment, right? But I know it's higher than the earnings that they report. So the GAAP earnings are 100% misleading when viewed quarterly or even annually, right? Because GAAP earnings actually include all the capital gains, right? Which is here, I think. So capital gains. So capital gains have been hugely important to Berkshire over the past decades, and they expect them to be meaningfully positive. But if you focus on quarter gyrations, it's actually mindlessly misleading to investors, right? So next, aided by Allegheny, our insurance float during 2022 from 147 billion went to 164 billion. So with disciplined underwriting, these funds have a decent chance of being cost-free, right? So this is one of the big tenets of success for Warren Buffett, that a lot of his cost of capital has actually been zero. Since purchasing our first property casualty insurer in 1967, Berkshire's insurance float has grown 8,000-fold. That is mind-boggling. So they repurchased 1.2% of the company's share. So this next part is Warren Buffett's thoughts on share buybacks, right? Which is incredibly important, and also it has changed a bit in the past decade or so, right? So the math isn't complicated. When the share count goes down, your interest in our many businesses go up. Every small bit helps if repurchases are made at value accretive prices, right? Basically saying that if you are purchasing shares back below intrinsic value, then it is value adding, right? So just as surely when a company overpays for share repurchases, the continuing shareholders lose, right? So that is very, very important when you look at companies that have share repurchases, right? At such times, gains only flow to the selling shareholders and to the friendly but expensive investment bankers who recommended the foolish purchases. So you can be sure that Warren Buffett doesn't have any investment bankers asking him to buy back shares, right? Because he'll do it himself. So this is the part where I say that Warren Buffett actually changed his thoughts on share repurchases, right? Gains from value accretive repurchases, it should be emphasized, right? And this is the real part, right? So benefit all shareholders in every respect. Imagine, if you will, three fully informed shareholders of a local auto dealership, one of whom who manages the business. Imagine further that one of the two passive owners wishes to sell his interest back to the company at an attractive price, right? That's the most important thing, right? Attractive price, right? To the two continuing shareholders. When completed, has this transaction harmed anyone? Is the manager somehow favored over the continuing passive owners? Has the public been hurt? So this is very different from the stance that he took from buying back shares just I don't know, maybe a decade or 2 decades ago, right? So 2 decades ago, Buffett would have never bought back shares, right? Because he felt like buying back shares was a way of taking from his shareholders, right? Which now maybe he has changed because due to old age, obviously he thought he would hold his shares forever, right? But due to old age, he now has realized that there will eventually be a need to sell these shares, right? So even though you are buying them, for an example, you believe that Berkshire will one day be $1 million a share, right? But you are buying now at 400,000-500,000, right? Even buying at 400,000-500,000 can be helping out those shareholders that want to sell, right? And in the past, Buffett has always thought that if I'm buying something that I know is going to be worth more, and now I'm buying it for less, am I not taking away from my shareholders and partners, right? And that is something that has changed with Buffett, right? So when you are told that all share repurchases are harmful to shareholders or to the country or particularly beneficial to CEOs, you are listening to either an economic illiterate or a silver-tongued demagogue, right? So that's what I'm talking about, right? In the past, Buffett has thought it was taken away from his shareholders, but now he has realized it's beneficial, right, to even the shareholders that sell out at considered low prices, right? So to elaborate a bit, obviously, this is the important part, right? If it's made, repurchases are made at value accretive prices, right? So basically, what Buffett is saying in this paragraph, right, is that you only want to buy back shares when they are low in price, right? And the reason Buffett didn't buy back shares in the past, right, is because he thought that when the prices are low, when you buy back the shares, you are taking away those future gains from your shareholders, right? But now he has realized that even though the prices are low, it can be beneficial to shareholders if you buy back shares, right? So if you're enjoying the video so far, do help me smash up the like button, hit subscribe, and also hit the bell button and press on all, right? So this will really help out the channel, and also watch till the end, right? Because obviously you don't want to miss any important information. So the next part, there are basically K33 to K66 are operations pages. So these pages are not, however, required reading. There are many Berkshire centimillionaires and yes, billionaires who have never studied our financial figures. They simply know that Charlie and I, along with our families and close friends, continue to have significant investments in Berkshire, and they trust us to treat their money as we do our own. And that is a promise we can make, right? So this is a guy that is obviously stapled with integrity, right? So finally, an important warning: even the operating earnings figure that we favor can easily be manipulated by managers who wish to do so, right? So obviously that's very important because the more people favor this way of looking at earnings, right? Which is, if let's say 100% of the market thinks to look at only operating earnings and not, let's say, net income per share or whatever it is, right? Then CEOs will start to manipulate this data because they know that if we come with better operating earnings, our share prices will go higher, we'll get better compensation packages or whatever it is, right? So that activity is disgusting. It requires no talent to manipulate numbers, only a deep desire to deceive is required, right? So bold imaginative accounting, right? CEO once told Buffett. So just this is a recap of Berkshire's story. So in 1965, Berkshire was a one-trick pony, the owner of a venerable but doomed New England textile operation. So it was the next few moves that really turned Berkshire into the beast it is today, right? So national indemnity became available in 1976, and then the continuous path of savings has started since then, right? So continuous savings by our owners, that is their retained earnings and the power of compounding, our avoidance of major mistakes, right? So he has obviously made a lot of mistakes, but no major mistakes. And most important of all, the American tailwind, right? America would have done fine without Berkshire. The reverse is not true. So Berkshire now enjoys a major ownership in an unmatched collection of huge, diversified businesses. Let's look at the 5,000 or so publicly traded companies that trade daily on Nasdaq, New York Stock Exchange, and other venues. Within this group is housed the members of S&P 500, an elite collection of large and well-known American companies. So in total, the S&P 500 earned 1.8 trillion in 2021. So he doesn't have the figures for 2022. That's why he's using 2021. only 128 out of the 500, and this includes Berkshire, earned 3 billion or more, right? And 23 lost money. At year end 2022, Berkshire was the largest owner of 8 of these giants, right? So out of 128, they are the major shareholders in 8 of it, right? So American Express, Bank of America, Chevron, Coca-Cola, HP, Moody's, Occidental Petroleum, and Paramount Global. So in addition to those 8 investees, Berkshire owns 100% of Burlington Northern Santa Fe, right? I don't know whether I'm pronouncing it correct. And 92% of Berkshire Hathaway Energy, each with earnings that exceed 3 billion, right? So if they were listed, they would basically be in those S&P 500 as well, right? So 5.9 billion at Burlington BNSF, right? And 4.3 billion at Berkshire Hathaway Energy. So were these companies publicly listed, they would replace 2 of the present members of the S&P 500, and all told, they have 10 companies that are aligned with the country's economic future. So this is more the case at Berkshire than any other US company, right? So basically what Buffett is saying here is that he's built basically the strongest and widest moat company that aligns itself with America's future, right? Basically, Berkshire's insurance operation, though conducted through many individually managed subsidiaries, has a value that is comparable to BNSF or Berkshire Hathaway Energy. So what he's saying here is, if all the insurance companies were in one company, they would have 11 out of the 128 companies that earn more than 3 billion a year. Right? So as for the future, Berkshire will always have a boatload of cash and US Treasury bills, along with a wide array of businesses. We will also avoid behavior that could result in any uncomfortable cash needs at inconvenient times, which this is basically him saying that you don't want to be squeezed out of the game at inopportune times, right? Including financial panics and unprecedented insurance losses, right? Our CEO will always be the chief risk officer, a task it is irresponsible to delegate to anyone else, right? So additionally, our future CEOs will always have a significant part of their net worth in Berkshire shares bought with their own money, right? So, and yes, our shareholders will continue to save and prosper by retained earnings. This is so important. At Berkshire, there will be no finish line. So I think 2 important points to take away from this message, right? So, this paragraph, right? So first of all, chief risk officer is the CEO's job, right? Basically to manage risk. And second of all, they always want future CEOs to have a significant part of their net worth in Berkshire Hathaway, right? So this doesn't mean that they have to own 10% of the company or as much as Buffett owns, but meaning if my net worth is 100 million, then I should have at least maybe 80, 90 million in Berkshire Hathaway, right? If I'm the CEO of Berkshire Hathaway. So during the decade ending in 2021, the United States Treasury received about 32.3 trillion in taxes, while it spent 43.9 million, right? So this is obviously the US being irresponsible with their money, right? They took in 32 trillion and they spent 44 trillion, right? Basically. So Berkshire's contribution to the income tax was 32 billion during that decade, right? Almost exactly a tenth of all the money, 1/10 of 1% of all the money the Treasury collected. So this means that if there were 1,000 more taxpayers in the US that is matching Berkshire's payment, no other businesses or any of the country's 131 million households would have to pay any taxes to the federal government, right? But obviously that's not happening because Berkshire is this one large company that, you know, is unprecedented before it, right? And there are no 1,000 Berkshires on the planet, right? If not, us as investors will be very, very rich, right? Probably. So next is a visualizer of how much money that he's talking about, right? So millions, billions, and trillions. We all know the words, but the sums involved are almost impossible to comprehend. So I'm just going to skip to the last one. Berkshire's 2012 to 2021 federal income tax payment, now the site grows 21 miles in height, right? So basically it's 21 miles tall, right? So about 3 times the level at which commercial airplanes usually cruise. And he's talking about basically if you have newly printed $100 bills, right? So basically it's 21 miles of newly printed $100 bills lying down straight on the floor. So at Berkshire, we hope and expect to pay as much or more in taxes during the next decade. We owe the country no less. America's dynamism has made a huge contribution to whatever success Berkshire has achieved, right? And Buffett really attributes a lot of his success to basically America instead of himself, right? So a contribution Berkshire will always need. We count on the American tailwind, and though it has become from time to time, its propelling force has always returned, right? So what he's saying is basically there has been times that America looked like it's not going to do very well. Mainly maybe the World Wars, Great Depression, and maybe even the financial crisis, right? But he says that the tailwind has always come back. So I have been investing in 80 years. Wow, that's a long time. I have yet to see a time where it made sense to make a long-term bet against America, right? And I think this is the most misquoted quote on the planet, right? Because a lot of people will say never bet against America, and that is very, very wrong, right? Because there are times where you should basically cash out of your stocks or even sell short, right? But I wouldn't encourage inexperienced people or even experienced people to sell short, right? But there are times that if you are selling shares, right, some people will say, oh, that's betting against America because people expect numbers to continue growing up, right? But what he's saying here is a long-term bet against America. Basically, if you wanted to sell short for 10 years, right, and that would make absolutely no sense. But if you wanted to sell short for 6 months or 1 year, right, that is actually a short-term bet, which sometimes it does make sense to take, right? So nothing beats having a great partner. What it takes me a page to explain, he sums up in a sentence. His version, moreover, is always more clearly reasoned and also more artful. Some might add blunt, right? So if you want to read all of Charlie Munger's incredible quotes, right, I think you're going to have to pause and read it slowly one by one yourself, right? Because this has been my longest video ever and I'm still not done yet, right? So I'll give you another second. Okay. So I have never had a phone call with Charlie without learning something. And while he makes me think, he also makes me laugh, right? So that's the importance of having good friends. So find a very smart, high-grade partner and preferably slightly older than you, and then listen very carefully to what they have to say, right? So Charlie and I are shameless. Last year, our first shareholder get together in 3 years, we greeted you with our usual commercial hustle, right? So basically, this is him selling goods and services at the Berkshire Hathaway meeting, where basically you're selling to your own shareholders, right? So that's what he's saying. So I'm not going to go through the amounts, right? Charlie and I and the entire Berkshire bunch look forward to seeing you again in Omaha on May 5th to 6th, right? So I haven't been fortunate enough to go and visit them once in my life, so hopefully I will get to do it, right? And we will have a good time, and so will you. So absolutely fantastic letter as always, right, from Warren Buffett. So two things that I really want to highlight from this letter, right, is this, right? Number one, right, so Berkshire will always hold a boatload of cash and US Treasury bills along with a wide array of businesses, right? So we will also avoid any behavior that will result in any uncomfortable cash needs at inconvenient times, right? This is basically Warren Buffett telling you to, first of all, not use margin and not allow anyone to tell you when the game is over or when the game is started, right? Basically, he wants to have enough comfort and also liquidity to get through whatever times it is, right? Because if you don't have that, actually you are in a sense a speculator and not an investor, right? An investor can hold on to his shares and even add more during all this distress time, right? Because imagine just for a moment, right? Even if you don't use margin or anything like that, right? But your living expenses spike or you have emergencies that you need the money, right? In effect, actually it is a margin call on your stocks, right? Because it tells you when you can play or when you cannot play the game, right? And that is a very, very important thing to have, right? You want to be able to play whenever you please, right? And number two is obviously position sizing, right? I think these are my two most important takeaways among many out of this letter, right? But I think the top two would be first of all, never use margin and don't use leverage and all these things. Of course, there are situations that you can actually use leverage, such as maybe a real estate deal or whatever it is, right? But in equities, most of the time, you don't need to take on any leverage, right? So number two is obviously the position sizing, right? And I've talked enough about this in this video, so I'm not really gonna explain again, right? But basically, position sizing is incredibly important, right? Everything that Buffett does now, he wants it to move the needle, or he's not doing it at all, right? So yeah, that's about all I wanted to share today. So long video. If you made it to the end, do help me smash up the like button, hit subscribe, and also hit the bell button. With that being said, have a fantastic day ahead, and peace out.